Speaking of streaming, Netflix posted an earnings beat ahead of course, the long weekend. The company's saying there's been, quote, no material change to its overall business outlook. Let's bring in Loop Capital analyst Alan Gould. Has a hold rating. His price target is about $20 from here, $1,000. We'll also talk with Oppenheimer analyst Jason Helfstein. He's a buy, bumped up his price target as well. Alan, you made the trip down here, so you get to start. Why only a hold at this point, given, I would assume you would agree, what was a pretty strong quarter?
Yeah, good morning, David. Yeah, Netflix has done superbly. They've won the streaming wars. You know, first quarter beat the street estimates. Second quarter was ahead of consensus, the guidance. Full year, they didn't raise the numbers. Why? We are simply at a hold because of valuation. Netflix is doing a superb job. We realize they're somewhat impervious to tariffs and the economy. That's why Netflix is up 10% year to date. The Mag 7's down 20-some% year to date. We just think it's reflected in the stock price.
All right. Well, valuation. Give me your numbers and why at least that doesn't represent for you a buy at this level.
Yeah, so let's even go out to 2030, which is also the numbers that they had, their internally leaked numbers. We're somewhere around $60 a share. Give a 25 multiple on that, discount that back 10% a year. It gets you to around 1025, 1050. And if you look at it, some of the great companies, the Microsofts, the Amazons, the Apples, they trade about 27 times this year's earnings. So a 25 multiple on out-year numbers seems like a pretty reasonable place to be.
Yeah. Jason, did that give you any pause in terms of having a buy in the stock at these levels?
Several things. Number one, we think on the out year, that 2030, kind of where we think it plays out, you're actually paying more like 20 times earnings, discounted back at a 7% discount rate. So you have that. Look, you know, we've clearly seen what the market will pay for, you know, the beloved stocks, and obviously, you know, the Nvidias and, you know, the Amazons are well off their highs. But there's definitely a premium that the markets want to pay, and so we're just comfortable with that out-year estimate, which was actually 4% higher than our estimate, and kind of got there more on pricing. So, I mean, really, I'll just say this. Unless the U.S. media industry goes through consolidation, allowing other streaming services to merge and then lower their churn, that is really the main competitive dynamic. The other streaming services cannot compete with Netflix when it comes to content versus marketing spending.
So we need that consolidation, in your opinion, to represent a real competitive threat to them. I mean, there was nothing in the current report then, Jason, that gave you any pause?
No, I mean, revenue was, a point better than us, in line with the street for revenue. Margins came in better. Second quarter guidance was ahead, despite them keeping full year guide the same, which would imply a back half slowdown despite currency now becoming neutral or maybe even a tailwind. So it would mean the back half estimates are actually conservative, right? So they'll probably beat. And then if you look at metrics, historically, when there's a kind of economic uncertainty, consumers spend more time with television. There was a Stanford survey that backed this up. In 2008, 2009 recession, you went from 2 to 2.8 hours a day versus kind of the prior 2.6 hours. And in the 2012 European recession, Netflix accelerated their net add. So everything suggests that this is a stock to own in your portfolio for the next 6 to 9 months.
You know, on the guidance, Alan, I'm curious if you're still on hold, what you like better. I mean, how many other companies that are this sort of old and established are growing? What did they project, 17% next quarter, ex-FX?
Yeah, well, it's one quarter. Yeah, it's 17% ex-FX, with 16% this quarter. They do have some benefit from the recent price increase that fully reflects the second quarter. So 2Q will probably be the strongest growth. But listen, they've done a great job. It just comes down to valuation. In terms of Jason's point, yeah, there will be consolidation. There has to be consolidation among the traditional guys. But then once they consolidate, will they still be licensing as much content to Netflix, which has been a great cheap source of programming? So there's going to be pros and cons of consolidation. I think there'll always be 3 or 4, whether it'll be Netflix, Amazon, Disney, who knows what the heck Apple's going to do. So there'll still be some competition here.
Apple has Severance and The Studio, which are like 2 of the best shows on television right now.
And your friend